for business now with Kate Moody. Hi, Kate.
Hi there.
The European Central Bank is setting the stage to raise interest rates for the first time in over a decade.
Yeah, a series of rate hikes on the cards for the second half of the year, starting next month once the ECB wraps up its emergency bond buying program on the 1st of July. The ECB's main interest rate on deposits is currently minus 0.5%. It has been below zero for the past 8 years, which was basically a way of encouraging spending rather than saving to boost economic growth. Policymakers plan to raise that by a 0.25 percentage point in July before possibly accelerating the pace and imposing 0.5 percentage point hikes going forward. This is an effort to rein in inflation, which hit a record high of 8.1% in May, driven by surging energy prices. Here's the ECB chief, Christine Lagarde.
High inflation is a major challenge for all of us. The Governing Council will make sure that inflation returns to our 2% target over the medium term.
Well, for some insight now, we can speak to Frédérik Ducrozet, head of Macroeconomic Research at Pictet Wealth Management. Thanks for being with us on France 24. This fairly cautious pace of change in July is broadly what was expected from the ECB.
Yes, indeed. I think it provides some clarity to market, removing the uncertainty over the size of the first hike, whether it will be 25 or 50 basis points. That's one thing that's cleared for markets. But beyond that, a lot of questions remain. And I think Christine Lagarde made it clear that the decision from September will be even more data dependent than they used to be. And if the inflation outlook stabilizes or deteriorates further, she made clear that a larger hike would be on the table. And indeed, I think the most likely outcome at this stage is that they hike by 50 basis points in September, which, as you said, is effectively a faster pace of normalization and brings probably a lot of challenges.
Now, inflation in the Eurozone did hit a record high, over 8% in May. Remind us concretely how this move by the ECB will help households and businesses deal with these surging prices, and do you think it will be fast enough?
Well, the president had a very candid answer to that question. She admitted that the first hikes at least will have little to no effect on inflation in the very near term. The first reason for that is that the bulk of inflation is actually imported from outside, from commodity prices, from the currency weakness, from things like that. And only a small share is actually under the ECB's control. The second reason is that there are lags in monetary policy transmission, and you have to wait for the full effect of this tightening to be visible in the data. So at best, I think by the end of the year, the ECB will be hoping that inflation finally starts to ease.
Now, the US Federal Reserve and Bank of England have already started hiking their own interest rates in the US with comparatively aggressive 0.5 percentage point moves. Why has the ECB taken so long to do the same?
I think there are both good and bad reasons for that, for being late in the euro area. The good reason is that, there are vulnerabilities, not only because of the war in Ukraine, but also because of the lagging business cycle. The recovery in the economy, the recovery, including in the labor market, has lagged the US, including for fiscal reasons, because the fiscal response in the US was much more ambitious. And the bad reason, if I may, is that the ECB has sticked with its so-called sequencing, meaning that they had to stop asset purchases first before they could actually hike interest rates. And if you ask me, if you ask them, I think a lot of the Governing Council members would have liked to hike rates today, not on the 21st of July.
And of course, this is a balancing act for policymakers around the world trying to raise interest rates while not slowing economic growth. The ECB decisions apply to 19 different member states. They're all facing high inflation, but their economies aren't necessarily in the same position. Will this affect different Eurozone economies in different ways?
Yes, indeed. And one country we all have in mind at the moment is Italy. Because of the vulnerability that I mentioned, because of the high level of public debt and the higher sensitivity of any increase in borrowing cost. And I think today there was a bit of disappointment in markets, in part due to the fact that we had no new information in terms of the potential tool that could deal with this so-called fragmentation in market, in Italian market in particular. I think the ECB ultimately will have to do something about it, and it may take a much larger widening in spreads or a much more severe deterioration in market conditions for the ECB to deliver on that tool.
And it is worth underscoring that the ECB has had these ultra-loose policies for the better part of a decade, before the pandemic, before the war in Ukraine. What might neutral interest rates or normal monetary policy in the Eurozone look like?
We have no idea. I think the ECB has no idea. The range of estimates is around between 1% and 2%, let's say. And the hawkish part of the Governing Council is likely to try and hike rates until 2%, which would be a fairly ambitious path towards neutral rates. I think that unfortunately, because of the economy and the weakness at the moment, because of the war, because of the fragmentation in peripheral bond markets, or perhaps because of a combination of all those factors, the ECB might struggle to actually reach 2% or similar level in terms of interest rates.
Frédérik Ducrozet, thank you for bringing your insight to France 24. And Charles, that's all the business news for now. I'll just point out that the European markets did close lower, even though those ECB announcements were pretty much in line with what we were expecting. Losses of around 1.5% in each London, Paris and Frankfurt today.
Thank you very much, Kate Moody. That's Kate Moody with the business. That's it for this edition, but do stay tuned. Coming up, the France 24